Hi, welcome to Cultivate CFO. This podcast is called Building Wealth, Reducing Taxes, the game most people don't even know they're losing. In this podcast, we're going to discover how to develop a winning tax planning strategy to support your wealth building goals as a business owner or investor. You're going to learn key strategies to minimize taxes and maximize wealth in this podcast and tax planning series. As a disclaimer, my goal in these podcasts is to simplify the complex and help you take the next step in your financial situation. As such, this is not a comprehensive deep dive into every possible nuance or strategy. This podcast, like all of my resources, is intended solely for educational purposes and should not substitute for specific investment, financial, or tax advice. So always consult a qualified tax professional for guidance about your tax situation. The key takeaways for this podcast are to first discover how business owners and employees faced vastly different tax realities based on gross income versus net income. Next, are you ready to make a strategic move in your wealth building game? Transitioning from employee or self-employed to a business owner and an investor is essential. That's where you'll find winning wealth and tax strategies. Next, we'll look at 4 questions to position for maximum tax savings. The first is, where are you starting with your wealth? The second, where do you want to go? The third, how flexible is your growth strategy? And fourth, what's the big picture for your wealth and tax strategy? And finally, we'll explore 5 fundamental strategies to reduce taxes: elimination, deductions, conversion, brackets, and deferrals. So this podcast is the third in our tax planning series, designed for the frustrated business owner or investor who needs to develop innovative and effective tax planning strategies to support their wealth building goals. It's for those who are frustrated with the amount of tax that they owe and want to figure out the rules of the tax game and develop a winning strategy. It's for those who are seeking to build their wealth and grow a business, but hate being set back by the big IRS check that goes out the door every single year. In this podcast, I'm going to help you understand where to start with your tax planning strategy, how to evaluate your current tax position, how to position your income and wealth for maximum tax savings, and finally, how to apply tax strategies to key areas. Decoding tax planning strategy. F.J. Raymond said, "Next to being shot at and missed, nothing is really quite as satisfying as an income tax refund." When I dive into tax planning with clients, I ask whether they've done tax planning before. Often the most they've done is to get help with their estimated tax payments or putting an S corporation together. Very few have actually moved the needle on significantly reducing their tax liability. Many people come to me knowing that they want to reduce their tax liability, but they don't know where to start. They have wealth building goals, but they don't know the strategies or implications of their financial decisions on their tax liability. And to their credit, the tax law is complicated and the IRS codes are endlessly complex, with new tax laws coming out every year. With all this complication, how should you approach building your tax planning strategy? Here are 3 simple steps you should take in building a robust tax planning strategy. Number 1, understand where you are in relation to the government's goals. Number 2, position yourself for maximum tax savings. And number 3, apply specific tax strategies in areas of alignment. The second step is the focus of this podcast. The third is in the following podcast, and the first was discussed in a previous podcast. What is your current tax position? As a recap of the prior podcast, what the government wants with taxes, and how to unlock tax savings, let's review the government's goals below. The government's goals. If you haven't reviewed that prior podcast or the article, you can find a link at marksharman.cultivatecfo.com. But you should ask yourself, what are my goals for wealth creation? Remember that we aren't focused on tax savings to spite the government. We want tax savings to increase your wealth. Second, what investment options that the government incentivizes will help you reach those goals. The best tax planning investments are business, research and development, real estate, energy, agriculture, insurance, and retirement and estate. Third, what of those investment options will produce the greatest wealth with the least amount of taxes? This is the question that this podcast and the rest in this series will uncover. Positioning yourself for maximum tax savings. The best way to understand how to maximize your tax savings is to get into a position that allows you to both align with the government's goals and incentives and your own personal goals for wealth creation. The simplest model that I've found for understanding how to position yourself is from Robert Kiyosaki. Robert Kiyosaki's Cash Flow Quadrant. In Robert Kiyosaki's book, Cash Flow Quadrant, Kiyosaki builds on his framework in Rich Dad, Poor Dad by providing a way of thinking about the world between those who trade time for money through paychecks from others, employees and self-employed on the left side, and those who receive money from businesses and investments on the right side. And in the article and in the video, we see the cash flow quadrant. It's got the employee in the top left, self-employed in the bottom left, business owner on the top right, and investor on the bottom right. You can read more about the fundamentals of Kiyosaki's cash flow quadrant as it applies to business at www.richdad.com/cashflowquadrant-fundamentals. Cash flow quadrant and your taxes. The cash flow quadrant is a simple yet powerful illustration of how different income and investments are taxed differently. In the article, I've put a link to a curated video that I put together with Robert Kiyosaki and Tom Wheelwright explaining the cash flow quadrant and taxes. You can see this video in the original article at marksharman.cultivatecfo.com. The cash flow quadrant is an excellent basic framework for understanding income and wealth generation at a fundamental level, but it also has a significant impact on how you are positioned for tax savings. Tom Wheelwright showed that you can also include rough tax rates for each of these quadrants as follows. For employees, 40% tax. For self-employed, 60% tax. For the business owner, 20% tax. And for the investor, 0% tax. Do you see how it works in this quadrant? The left side, employee and self-employed, you work, you get paid, you get taxed a lot. On the right side, the business owner investor, you invest, you earn, you get taxed, but significantly less with many more legal loopholes. On its face, that sounds really unfair, and I'm not going to tell you that it isn't. But tax law has evolved just like water running downhill. It is going to take the path of least resistance to its goals. Business owners and investors put up a fight and try to find ways to avoid taxes, while employees and self-employed generally don't even show up for the game. On the one hand, the government has simply had an easier time taxing earned income from employees because they haven't made a fuss about it. On the other hand, business owners and investors have helped the government get what it really wants. Understand that this discrepancy is a feature, not a mistake, of a tax system that is designed to incentivize certain behaviors. Here's how the tax game plays out. Every good business owner and investor views taxes as a wealth drain and an expense that they actively position themselves to avoid to preserve their bottom line profits and wealth. Most employees and self-employed look at taxes as something they're destined to pay and can't get out of. Just look at the way a W-2 is set up. Do you get a choice to take your whole paycheck? No. It's taken out before you even get paid. In fact, most employees go right along and even increase their withholdings and estimated tax payments and celebrate the refund when they withhold more than they owe. They're relieved that the extraction process is over and try to ignore how much of their hard-earned money has just gone out the window. While everyone operates under the same tax code, the amount of tax you pay will vary widely based on the kind of income you receive. I've included the types of income found in each quadrant in an image in the article on Substack to help you see the differences. Let me break them down for you. Employees pay tax on earned income that is always charged at the highest tax rates and combines ordinary income tax with employment taxes against the gross income earned. Next is ordinary income from businesses, which is taxed at high ordinary income tax rates, but this is on the net income earned and not the gross. Investment income is charged the lower capital gains and passive income rates, but this is also reduced by passive losses and paper, not cash, expenses like depreciation and depletion. Gifts and inheritances are mostly structured for no income tax burden at all, and while the lower and middle class do get some benefit, this benefit is primarily enjoyed by the wealthiest classes. It isn't that there is a different tax code for business owners and investors, and another one for employees and self-employed, but rather the kinds of activities are taxed differently regardless of who is being taxed. W-2 employees and self-employed individuals have earned income, which is taxed at the highest federal and state tax rates, as well as payroll taxes and self-employment taxes for Social Security and Medicare. But this isn't actually the biggest difference between the left and the right side of the cash flow quadrant. The real difference? Gross or net income. The most critical distinction in tax planning is understanding gross and net income. Business owners pay ordinary income tax rates like employees, but not before being able to take deductions to reduce their net taxable income. Investors are typically taxed at lower rates through most of their income coming from capital gains and passive income, which are all after expense figures. However, they also get to offset against other expenses and losses as well as asset depreciation like in real estate and oil and gas investments. Here's the big idea. The real difference is what you're taxed on, gross income or net income. That's the game changer. Here is the order of events for employees versus business owners that shows why employees will always be taxed higher than business owners. For an employee, they're going to earn their income, and then they're going to pay their taxes, and then they're going to go on to pay their living expenses and everything else. And they net out. The business owner, on the other hand, even if he makes the exact same amount of money, he's going to take that earned income, then he's going to be able to deduct his expenses, and then he's going to pay taxes, typically about half as much as the employee or more. That's going to leave twice as much left over. Here's the key. If an employee and a business owner make the exact same top line income, the business owner will always pay less in taxes. A key distinction between self-employed and business owner that I want to draw out is this. You may be someone who falls into the self-employed category. You might be asking yourself whether you're a self-employed or a business owner. Here is a key strategy that we use to make this distinction and to move you from self-employed to a business owner. The difference is a Schedule C or an S corporation. If you're still filing your business as a Schedule C, you're predominantly in the self-employed category. If you have an S corporation, you've taken the first step to being a business owner. So what's the difference? S corporation owners are able to pay themselves a reasonable salary, yes, that's an IRS term, for their earned income, which is the left side of the quadrant, think employee. And they're able to also take their dividends out as owners, or the right side of the quadrant. This enables them to reduce the self-employment taxes on the value the business is bringing them beyond their invested or earned efforts. There are rules to follow, which I've detailed in another podcast and article, but this is an excellent straightforward strategy that will deliver you ongoing savings for years to come. Incentives given to employees versus business owners and investors. The government is always going to provide business owners and investors with the best deals because they are the ones with the ability to give the government what it wants: economic growth and stability, social welfare, and national security. This next chart shows where the majority of the partnerships and related tax savings occur between the government and its citizens. And in this chart, we see that the employed and self-employed get some insurance and some retirement tax savings. Ultimately, what this chart shows is those who are passive and those who are active participants in the game of tax. The key idea is this: you can either partner with the government and engage in the strategic positioning of your assets and wealth, or you can draw back and let the game be played at your expense. When we add to these quadrants the amount of tax planning strategies and savings options available to each quadrant, the difference becomes glaringly obvious. Here's the idea: if you want to build wealth and save taxes, you must play the game as a business owner and an investor. Apply tax strategies to key areas of alignment. The key lies in your facts and circumstances. If you want to change your tax liability, change the facts and circumstances around your income and assets. After understanding where you are in relation to the government's goals and knowing how to position yourself for maximum tax savings, this third step is about applying specific tax strategies in key areas of alignment between your wealth strategy, available businesses and investments, and the government's goals and incentives for you. So let's check on your progress so that we can see how to apply the appropriate tax strategies. 4 questions to maximize tax savings. Question number 1. Where are you starting with your wealth? Take a look at the quadrants in the article. Where are you now? How secure is your job? What investments and businesses and income do you have? You might have some income in a few of the different quadrants. Question number 2. Where do you want to go? What areas make sense in your plan to build wealth? What are your plans for your business and investments? Where would you ideally land and how long will it take? Question number 3. How flexible is your growth strategy? Are there different ways to get to your goals? What's the trade-off between wealth creation and tax savings? And question number 4. What's the big picture for your wealth and tax strategy? Is everything in alignment? Where are you misaligned for your goals? Where are you misaligned for maximizing tax savings? And what do you need to change today? After pulling all of this together, you'll want to construct your plan for building your wealth. Keep the big picture goals in mind and consider that you will need to be flexible in how you build your investments and business opportunities to reach these goals. Make a list of each investment, business, and asset that you own or plan to build or own in the future. Here's the key thing I want you to take away. If your tax planning and your wealth creation are not aligned, you're simply shooting holes in both. 5 ways to eliminate or reduce income taxes. We're going to explore some specific tax strategies in the next few podcasts, and as you review these strategies, I want you to consider how they fit in the following 5 ways you can eliminate or reduce your tax liability. Understanding these options will help you know how to prioritize the different strategies available to you. Step number 1, elimination. The best option is for you to eliminate taxes altogether. You can eliminate taxes through tax-free income and tax credits. Some examples include structuring real estate to maximize basis step-up rules in your estate, growing wealth tax-free in insurance vehicles, utilizing research and development tax credits, and other government tax credits. Step number 2, deductions. The next best option for eliminating taxes is to reduce your taxable income through deductions. The principle is this: lazy money that you save or spend gets taxed, but working money that you invest gets tax savings. Instead of holding onto your profits as cash, look for ways to reinvest your money in ways that both grow your wealth and unlock deductions. This could be through investing in real estate, reinvesting profits back into your business, or simply maximizing all of your legally available deductions. How do you know whether you can deduct something? The real idea is, if the purpose of the expense is to help you produce more income, it is almost always deductible. With this in mind, given the right facts and circumstances, almost anything can be a deductible expense. Step number 3, conversion. If you can't eliminate taxes, your next best option is to find ways to move income from higher taxed income to lower taxed income. I discussed this previously when we thought about moving income from the left side of the quadrant to the right side. One example of this is transitioning your investment strategy from real estate development, or fix and flips, to buy, improve, hold, and then sell that real estate. This converts the gains that you've built into the investment through your improvements from ordinary income into capital gains. Another example is what we discussed previously with converting a Schedule C business into an S corporation to convert the income from earned income to passive dividend income, thus avoiding the self-employment taxes on that income. Number 4, brackets. Once you've converted income, you need to try to move income into the lowest tax brackets possible, including the various tax brackets found in the following tax types: ordinary income, capital gains, state, net investment income tax, alternative minimum tax, and others. This often involves income smoothing strategies to keep your income in the lowest tax brackets from year to year. Deductions and overall reduction of your income will help you reach these lower tax brackets, so it can be important to know each of the tax thresholds to know what you're targeting for your net income. One example I've explored with business owners that fall under the qualified business income deductions definition of a specified service trade or business is to make sure that they fall under the income thresholds to take this 20% deduction. This can make a significant difference in their bottom line taxable income. The phase out of this threshold in 2024 is from $191,000 to $241,000 for single filers, and $383,000 to $483,000 for joint filers. You can read the IRS guidelines for more information. And finally, number 5 is deferral. Postponing taxes to a later year is generally your last step, as you don't want to build a problem for yourself down the road. But all else being equal, the time value of money principle shows us that it is still better to pay the same amount later than it is to pay it today. A simple example everyone can understand is a retirement contribution. Making tax-deferred contributions to retirement is the simplest way for both employees and business owners to defer taxes until retirement. Just make sure that you aren't building a ticking time bomb for yourself down the road. I've seen this in 2 different situations. First, someone contributes more than they can afford, and then it ends up having to withdraw their retirement funds down the road for an emergency, and ends up having to pay the 10% IRS penalty for early withdrawal, along with the taxes for that income in that year. Second, someone contributes to retirement but doesn't plan their retirement income well. They end up being forced to take out too much income each year due to the required minimum distributions from retirement accounts, and end up in a higher tax bracket than the tax rates they would have paid those years earlier when they had deferred the income. Other podcasts in this series. In the following podcasts in this series, we're going to take this list and use it to review how to apply specific tax strategies. Each article will provide a high-level overview of the strategic landscape along with key tax strategies for you to consider. Advanced tax planning strategies. In this podcast, we'll review tax planning strategies for business owners, for real estate, energy investments, retirement, estate, maximizing charitable tax planning strategies, insurance tax planning strategies, farm and ranch, and education. You can also check out the podcast Multi-Dimensional Tax Planning, Why the Wealthy Win and You Lose. And finally, Tax Planning Strategies of the Ultra-Rich. There's a lot more to cover, but for now, digest this information, think about your own situation, and get ready to make some smart moves. Welcome to the game. It's time to start winning. Was this podcast and the perspectives of the cash flow quadrant in relation to taxes helpful for you? Please share so that others can learn how to be more strategic in managing their tax liability. And as always, if you have any questions or further thoughts, feel free to drop them in the comments so that we can dive deeper.